Welcome to Tanks Invest. We talk about investing, finance, and professional development. So I've been getting this question a lot, so I decided to do a conceptual video today, a quick one, just to reframe and get back into fundamentals, if you may, right? So the topic is basically around how to take profit properly, right? So in that question, there are two mindset that I want you to be aware of. So there's a short-term way of taking profit, and also there's a long-term way of taking profit, right? So taking the first one, right, with respect to the long-term way of taking profit, which is typically the way that I prefer, because it eliminates the timing element, which you can never predict, and also eliminates the subsequent foreshadow events that you frankly have no control over. But just knowing that long-term fundamental, the value up proposition of the specific assets or the company that you invested in will arise eventually, as obviously it cultivates going forward, right? So it's more like a hard number that you have in your mind by doing financial calculations, right? Using fundamental analysis, basically calculate out what's the valuation that you expect is going to be happening in the next 5 to 10 years, right? So that's like a long-term perspective. But short-term perspective is more relevant to people that want to, be more in tune with the dynamics of the market circulations, both triangulating the technical analysis and the fundamental analysis, right? And the topic of discussions today is more cultivated around the short-term profit-taking methodology. Okay, so bear with me. I hope I haven't lost you yet, and I hope that my explanation is not too convoluted. I try to break it down as simple as possible in a more of a graphical perspective. That's why let's just do it in front of us by looking at historicals to relearn some of the lessons that we've learned before, right? So look at Bitcoin, right? Like the perfect scenario that we see here, right? That was a perfect opportune time for us to take profit was when you were basically at all-time high, right? Or approximating to all-time high of 67, 69, right? Why was the reason, 69 or 67 a great opportunity to take profits, right? And the short-term perspective, obviously, right? Because Bitcoin still has a lot more room to run up to. It's a couple of things, right? And if you have a piece of paper or notebook, feel free to take notes right now. So as you can see, right, historically, we were surging relatively massively. And the reason we had this pump, and the market was incentivized to do the pump, obviously due to its own micro and macro affectation, right? But at the same time, the technicals at a relatively oversold level, you could see that we're somewhere around like the 34 and 30, right? And as the rotation come in, you could see that clearly at that point, that was the perfect time to buy. Why was that? Because the golden cross was formed at that point, right? I always love this type of setup. Whenever you look at a stock, whenever you look at a crypto assets or whatever, look at the technical fundamentals, right? Are we depleted on the RSI? Number one. Number two, are we about to form our golden cross, right? So those are always the good time to be buying at. And at the same time, why was this a good level to buy? Because if you look at the consolidated aspect perspective, we've been consolidating on a sideways fashion for quite some time, right? And also this is something that's called a downward wedge at the same time, right? So without going too convoluted, let's just take a look at what happened subsequently, right? You see that we surge up all the way after the golden cross form, which is always the truth, right? And as that happened, we were at the 34 and we slowly appreciate up all the way to 74, right? And you could see that, was it a good time to take profit when we were at the 55, right? The answer is basically, it's more of a risk tolerance type of perspective, right? But if you triangulate that with the MACD, you could understand that we were forming no form of curvature yet, right? You ideally want to be taking profit when you're looking for an apex on the MACD front, right? I hope I haven't lost you yet, right? And the logical thing, I know some people would probably take profit because at that point you were already curving down on RSI, but the MACD has not curved down yet. So technically, if you think of this like a baseball, right? MACD is typically like a momentum of how the baseball, is what's the trajectory looking like. It also shows you like psychological chart of people's emotions being applied to the market dynamics, right? So as you hit that level, obviously, right, on the RSI you were dipping, but MACD still shows signs of bullishness, right? It has not formed an apex yet, right? So as you durate, and logical course of cadence is that you were already overbought, right? You could see that you were basically levitating above 70 out of 70. But you know that in your mind that the market is already really overbought. You should be taking profit any day now, right? But you wait, you look into the MACD, right? And some of the people are a little bit more risk averse, like myself. I would have probably taken profit like somewhere around like when we were like the 60, when we were just at the relatively extreme oversold of 76 out of 70, obviously, right? And as you keep going, right, which was basically, this is something that is just euphoria being pumped in all spectrum, that why is that also triangulating onto the technicals? Because the MACD was really relatively largely separated. So when you see a large separation, that means it's high euphoria, high emotional roller coaster that's been in play right now. So definitely not advisable to be buying, especially. You typically want to have more like flat to kind of close in separation, at the same time deplete on our RSI, right? So as you could see that as we got all the way to 67, which is way, just a little bit before the all-time high was 69, right? You form an apex here, and that was the time to be technically selling. Whenever you see an apex on a MACD, and at the same time RSI checks out to be really overbought, and you were crazy overbought at 84 out of 70, that was the time to sell, right? And you could see that some people actually sold, right? And why was that a good time to sell? Because the depth cross was already formed, right? And this is a good sign whenever you see some sort of an apex, right? An apex is the tippy point of the mountain, at the same time being matched with the RSI that's extremely overbought, right? And that's what happens as you deplete, right? And next thing you know, what happened, right? You form a depth cross, and some people with that are inexperienced would be buying somewhere around these areas, right? Thinking that will keep going up, right? Which is true, it happened, right? But this is something called a bull trap, right? And why am I calling this as a bull trap? The reason is because, if you are inexperienced, you would think that this is maybe like a cup and handle, which is true. It looks like it, right? You're seeing a cup that's being formed, and this is technically a handle that was about to be formed, right? But a cup and handle can only be incentivized if the RSI was more depleted below, right? And you could see that it was not, right? When we were like trying to form a handle, we were already at 60 out of 70, so it's really overbought. So the market was looking for an additional reason to sell off from there, right? So as you broke that cup and handle, you keep gliding back down, right? So people typically was expecting the all-time high, but if you look back and understood that, firstly, right, extremely overbought. Secondly, the line, the MACD line, which is a yellow line, is below the signal line, right? And whenever it's below the signal line, that means, despite my search up again, RSI is going to cancel it out. So it's a net negative thing. Do you understand what I'm trying to get at? I hope I haven't lost you. It's a lot of complexity in play, but I hope that my step-by-step explanation makes sense, right? And as that happened, obviously the cup and handle did not form. It broke down and kept sliding off from there, right? And what will be a better time to buy in as the next level, right? The next level to dollar cost average actually slide down, which was logical, right? The baseball was basically gliding back down to the ground, right? And we were looking for another level to get in, which was somewhere around like the depleted level, again, back to 33 out of 70, which was like when we depleted back to 45 after selling off from basically 60% down, right? And you can see that clearly right here, we were about to form a golden cross again, and you formed that up. But we've just been kind of consolidated on a sideways fashion. I would say we're still been kind of consolidated sideways fashion, but on a downtrend perspective, right? And at one point, because of the war breaking out, because of the FOMC meetings, we deplete all the way back down to 20 out of 70 at one point, right? And this was like the perfect opportune time to buy in right now, right? But in terms of the pattern right now, do we see, you know, Bitcoin to be keep going up, right? I think right now the trend is relatively comparable to the historical trends. You could see that we leaped up, but subsequently come back down. So I think, you know, we are still not out of the woods yet, because we try to form a cup and handle all over again, right? What we need to do is basically reach up all the way back up to the 43, right? And ideally have a little slightly dip back to the 41 and then surge up from there. But for us to do that, right, we have some room to get up to, but this is a large separation that we have right now. It is about to form a golden cross, so I think we are at the cusp of basically forming a cup and handle all over again. Does that make sense? Hopefully that makes sense, right? And the ideal perspective of how much to take profit when we're at that point was basically about 30% of your cash reserve. Not your cash reserve, 30% of your profit off the table and keep the rest running. And the reason to do that is because whenever you invest, you typically want to invest in long-term investments, right? Think of like the investments that you put in are like the vessels of your wealth cultivation, right? So you take the 30 off the table, so you keep that on the cash reserve, but you just know that as you come back down, which you will, because technicals never lie, right? As you could just, like the way I explained it just now, it never lies. It comes back down, and then you put the cash reserve that you took off, 30% of the profit, back into the equation, and you continue to cycle from there, and you continue to loop over and over again, right? Hopefully this makes sense. And obviously with my Patreon members that I have with my one-on-ones, I've described this to you guys many times ago, right? So let me know if this is sticking. I know it's a little complex, but it's about technical analysis. It's not about like momentum at all. It's about gauging the market cycle, gauging the market dynamics, using technical fundamentals to quantify your risk exposure to identify the trades. Okay, appreciate you. Let me know if you have any questions. Take care.